Hi, it's Jeffrey Cohen, Chicago Quantum, and I'm here to talk today, week 11, 2021, talking about the markets and giving you the weekly update on not only the markets but also the firm. And so, going to start it off by taking a look. This is FinViz. This is a week on the stock market. And so, weekly performance, S&P 500, and you see plenty of red. The big boxes are red. And so those are actually the NASDAQ type stocks like Microsoft, Google, Amazon, Tesla. Your credit services are down. And energy. Energy is bright red, very, very much down for the week. It looks like healthcare is picking up. Industrials are picking up. It looks like the core economy is doing fine, but tech's in trouble. And so I just wanted to also share, like I do, let's take a look at the world. And the world for the week is mixed. So U.S. tech, and if you take a look at China, China is quite red right now. Taiwan, Singapore, South Korea, India is red, Australia. So Asia's tough right now. Europe, pretty mixed. If you see plenty of green in there, right? And then when you look down at Brazil's mixed, Colombia, Argentina, but Canada's doing okay as well. So really the route that we've heard about for the week is largely in credit, energy, Tesla, and other NASDAQ. So why is that? Why would the damage or the hurt in the market be just here? And by the way, are there areas that have gone up? Sure. Telco looks good. Facebook looks good. Again, some healthcare. So let's take a look. If we look at bond yields, now it's funny because when I was earlier in my career, I used to spend a lot of time looking at bond yields. In fact, when I was a computer programmer working, my God, it's a long time ago now. Computer programmer, I used to have the this curve up on my desk. So what this is, so everyone can see it, this is a Treasury yield curve. And the blue is what it was a year ago, and the red is what it is now. And the way you read it is 1 month is effectively zero. You can see that here. It's a 1/100th of 1% interest. If you were to lend the money to the government, 3 months, 1/100th of 1%. 6 months, 3/100ths of 1%. Even 2 years, it's 0.16 of 1%. So it's like it's not a lot of money. So what's happened though is if you go up to the 10-year and the 30-year, you see the red line has gone up. So the red line would say we're at 1.71% interest rate if you lend the money to the government. So that doesn't seem like a lot of money, right? Would you give a loan for 10 years for 1.7% interest? I guess if you had nowhere else to put the money, but that number used to be lower, right? When you look at it a year ago, that number was like 1.2. And so the point is that the economy is more normalizing, right? And when you go up to 30 years, would you lend the government 30 years at 2.45% interest? No. You'd be thinking, I've got to fix up my house, or I'm going to buy some stocks, or I'm going to do something, right? I'm going to invest. I'm going to buy a building. I'm going to start a factory. I'm going to do something, right? Build a website even. And so 2.45% is still in the realm of normal. In fact, when you tie that up with an inflation estimate of roughly 2%, it's finally now paying some real interest. So in the grand scheme of things, these are not big numbers. But if you're trying to keep an asset bubble alive, if you're trying to keep the NASDAQ stocks moving, you want to keep interest rates low. You want them to be negative real interest rates, which means interest less inflation, right, is losing money. So you lose money when you put your money in the bank. Then you're going to dump it into stocks, bonds, anything you can get your hands on to make money. And so that's the context. So if you think about it, right, there's a big balloon, and we're letting a little bit of the air out because we've taken interest rates up to 1.71. Now, this is the market talking. The government doesn't set these rates. This is you and me talking. This is Napa Auto Parts talking. Well, I'm going to buy a bond or I'm not going to buy a bond, right? That's how it is. It's very important that you understand that the market sets the rates, especially at the long end. And so that's what we're seeing. If we take a look at the world, I want to point this out because first thing is the way you would read this chart is you see all these lines and you think, oh, Jeff, I just made it worse, not better. So let's see what I can do here. There we go. So there's a lot of lines going up and down. So this is starting at the week, February 19th. These are a whole bunch of stock exchanges. India, Hong Kong, Australia, South Korea, Germany, UK, Japan, and then two of ours, the S&P and the NASDAQ Composite. So if you look for the week, actually the DAX, the German market's up. It's up like 6%. The UK market. So Europe's doing okay. Europe's up for the week. Now we look at what's low. The Hang Seng is down. The NASDAQ is down. The Indian market is down. The Nikkei is down. The Australian's down. So Asia, risky US, down. The S&P, flat. So what you're seeing is Europe's up. Considering the emerging markets, the risky markets, Asian markets, I do not consider, by the way, Japan to be an emerging market, but just keep it in there anyway for simplicity. So Japan's down with the rest of them, and this is rough. If you take a look at this one, this is the composite. The NASDAQ was down 9% at one point during the week, and so now you don't feel so bad. It's down like 4.5%, right? But it was down 9%. So think about it, right? You have money in an investment. You're excited. You made some money, and now you didn't sell, right? And now you're hanging on, and it's down 9%. And so hopefully you didn't buy the stuff on margin and be like a weak hand, right? Because otherwise you got stopped out and you had to sell your investment. This is actually March 8th. I'm sorry. This is going back February. This is a month. Oh, we got to fix that. So I'm not sure why it showed a whole month. Let's show it for the week. That's interesting. I got all excited there. Yeah, the NASDAQ didn't fall 9% this week. So if we take a look at it for the week, thank you, by the way. Ask me anything if you'd like to ask a question. The chat lines are open, and I will take questions. I'm very excited about that. DAX is up. The Hang Seng actually recovered nicely. It was up almost 2%. Nikkei is up. It's actually flat. But you still see here, it's like India was down 2.3. It's a little different. So over the month, you saw there was some harm going on in Asia. Actually, for the week, it's not so bad. You had a couple markets down 1.5%. A couple markets up 0.5%, 1.5%. The DAX is still up and strong. Hang Seng is up. The Aussies are down. The S&P 500 and the NASDAQ are down. They've actually fallen quite a bit. It looks like into today. And India market's down. And so you see that there's a story, a bifurcation, in fact. And that's what's going on. A lot of movement. So I like to try to figure out what this is. Is this just bonds? I mean, is Asia tied to our bonds? Maybe. Maybe Europe, not as much, right? So now there's some other statistics I thought were important to share. These came up this week. One of them is housing. And this actually showed up Monday the 15th, and it's relevant. So what's going on is the amount of inventory of houses to buy is down. And they're saying actually that the housing stock in the United States of houses people might be wanting to buy or even possible to buy, there's fewer of them. So we're going to have to make more houses. It's kind of weird. We're going to make more houses. It's funny, right? With COVID, how do you get people together to make a house, right? I don't know that any houses in my neighborhood. I live in a North Shore in Chicago. I don't see really any new houses being built. I saw a couple maybe at the beginning of the year that had been started last year, but so we're going to have a dearth of housing supply, and you can see it here. And yeah, I don't think it's going to get any better until we start building, and that means housing builders probably going to do pretty well. In fact, our model picked Hovnanian Enterprises, HOV, and then the next day it was up like 10%. So we ran it for a client, so that's why I didn't publish it on Medium for y'all. But if you buy a run, you'll get those picks. You could have made the 10% yourself in a day. So I think this is important. I think you're going to see the real economy, pent-up demand, appliances, housing, cars, all those kind of core capital things that people have to buy. Because the United States people have been saving their money. And so there's spending power, but you can't do anything yet. We're still locked down. I'm going to talk a little bit later about COVID, because I was thinking about all this talk about COVID. What does it mean with the vaccine? And I've got some ideas on how it might relate to the market. So another thing happened that really, it upset me, it upset the market. So the price of oil dropped. I'm going to show you how to find the price of oil. You go to Yahoo Finance. By the way, I love Yahoo Finance. Oh, there's crude oil right on top. You click on it, and this is the forward month crude oil futures. So the way you would read this, hey now, let's do the full screen. Maybe that'll help. Well, we're going to bring it over. There it is. So crude oil futures, and there was a question as to whether crude oil futures are based on interest rates. And no, here's the thing. So we're going to do 5-day. We're going to do it based on the day. 5-day. All right, let's do it this way. Let's just look at it for March. And March, it was down, it was up. Look at that. March 10th, hit at $66. Felt great, right? I invested in a pipeline company, right? Who doesn't love $66 oil? But actually, at the same time, it was hurting people because the price of gasoline shot through the roof because those refineries shut down. And that's a problem, because now the supply of gasoline went down. The refineries can't turn back on right away. It takes time. And so take a look at this. But then all of a sudden, the price of oil drops from $64.60 to $60. Now, it recovered a little bit, but what caused that drop on the 17th? And it's the weirdest thing. I don't think it's interest rates. I don't think suddenly the Saudis decided to pump more oil, and it took the market down 10%. So scratching my head, what could have caused it? I think this caused it. George Stephanopoulos, on March 16, 2021, did an interview with our new president, President Biden, Joe Biden. And President Joe Biden was asked a question, and he answered it in the strangest way possible. I'm not going to find that quote, so now I got to find it the hard way. So it was a nice interview, a little bit off the cuff, kind of like my videos, right? He was like talking it up. He's talking about a lot of things. He talked about the COVID. He talked about the issues at the border where people are coming over, and he's talking about how we're going to protect the kids that come over. And by the way, I got an issue with that. I talked to my wife, who's a early childhood education specialist, deals with children, has worked with federal agencies, really cares about the kids, and we talked a little bit about it. So there's some issues. If you guys want to call me, I'm happy to share them. Get the wife on the phone. I talked about tax raises, which is enough to make me cringe a little bit, because I think it's going to hurt the market. And then here's the quote. George Stephanopoulos asked, so you know Vladimir Putin. You think he's a killer? I do. So what price must he pay? The price he's going to pay, well, you'll see shortly. I'm not going to. By the way, we ought to be able to, that trite expression, walk and chew gum at the same time. Well, there's places it's in our national interest to work together. He was probably referring to treaties I'm reminded of President Reagan talking about treaties in 1983. It's called the Evil Empire speech. By the way, I tweeted out that speech because this really brought me back to 1983. And President Biden, you should watch that speech. President Reagan gives a good example on how that speech might have gone a little differently. Well, so that's why I renewed the START agreement with him. START should be all capitalized. That's an arms treaty. That occurred while he's doing this, but that's overwhelming in the interest of humanity. That we diminish the prospect of nuclear exchange. But that solar winds as well. Well, he's done some mischievous things, to say the least. So we're going to have, I'm not going to announce what we're going to do and what I'm doing, but he's going to understand that. It's not free. So the Russians came back, they were insulted, right? Vladimir Putin, President Vladimir Putin, and I'm no Russia fan, but honestly, he looks like the good guy here. He says, hey, I'm rubber, you're glue. What you say bounces off of me and sticks on you. I couldn't believe he said that. Come on. And point is, they've recalled their ambassador. They're very upset. They're not sure what they're going to do about this. And they want an apology. In fact, President Putin has asked President Biden for a debate. Like Friday or Monday. I want it Monday because I got to go to my dacha. I'm going on vacation. And I guess President Biden said, well, I'm going to Atlanta. Not a vacation necessarily, but whatever. I don't know. But they got to work this out. You don't threaten a third most powerful nation in the world and call them killers for no reason. So we have something going on here that's really large, and I think this is what affected oil prices because Russia can increase production. They can help to manage, control, flood the oil markets, and I think that's what's going on here. It just really shook me up when I read it yesterday. I actually watched some of the video. It's on ABC News. I tweeted it out if you want to try to find it, and that shook me up a little bit. I think that shook the markets a little bit. He also talked about tax increases. So I want to talk a little bit about tax increases. Because whenever I hear about tax increases, I think about somebody putting the brakes on the economy. So we don't have enough houses, people trying to get back to work, and all of a sudden we're pumping the brakes, right? It's like weird because it's like you're pumping the gas with fiscal policy and monetary policy, but then you're tapping the brakes with tax policy. And so this is the tax foundation. It could have been any site. I'm not condoning or vouching for this website. I don't know anything about it. But what I do know is some key findings, right? No, it's got to be the stuff since after the election. They want to raise taxes. They want to raise the tax income rate up to maybe where it was, 39.6. They want to increase dividends and capital gains, long-term capital gains, to 39.6%. They want to increase the death tax a lot. So if you're passing money on to your next of kin, you're going to pay a lot of tax. I know that can be very high because in the old days, I was an executor for an estate and wrote a big, hefty 7-digit check to somebody, to the government. Caps the tax benefit of itemized deductions to 28% of value for those earning over $400,000. It phases out business deductions. It will expand the earned income tax credit. It will expand the child and dependent care tax credit. There's some other stuff here. I don't know. Oh, it increases the corporate tax rate from 21 to 28%. So all those U.S. corporations that moved back, where we pulled them back from Bermuda, Isle of Man, we pulled them back from Ireland. We're bringing the jobs back. Well, now we're going to raise the taxes. So 7% more of their earnings are going to go to the government. Great. Minimum tax on corporations. Double the tax rate on some intangible income. So, intangible income, I don't even know what that is. I assume it's important. we're just lots of new things, right? And so there's going to be new taxes. Oh, new surcharge on corporations that offshore manufacturing and service jobs. A 10% Made in America tax cut. There's a lot of stuff here. So what this tells me is no one really knows what's going to happen. But I did hear something where we're going to raise $300-400 billion a year in taxes to start paying for that $1.9 trillion handout that we did. And the previous $1 trillion and the previous $1 trillion, someone's got to pay for that. And so we're going to pay for that. And it's going to affect economic activity. So I think this is part of a little bit of letting the air out of the bubble, is the economic issue. So now let's take a look at our budget. So I was thinking about it. Why would interest rates go up? Well, interest rates go up, yields on long-term U.S. government debt go up, because people are willing to pay less for the debt. So why would that be? Well, supply and demand. By the way, I'm on vacation next week, and I'm going to be reading some pretty cool books. The Dow Theory, which is charting. Benjamin Graham, Intelligent Investor. I've already read it. I'm going to read it again. Technical Analysis of Stock Trends. Edwards and McGee. 5th edition, by the way. Please don't go past the 5th edition. And this was recommended by a friend of mine. Good book. By the way, Head and Shoulders. It's not just a shampoo. It's important. So once you read Edwards and McGee, you'll understand what I mean. Head and Shoulders is not just a shampoo. It's something you got to know about. So the long-term budget outlook, this is the Congressional Budget Office. This is a nonpartisan analysis for the U.S. Congress. They do this, right? So deficit. So at an estimated 10.3% of gross domestic product, the deficit in 2021, and that would end in September 30, will be the second largest since World War II. Exceeded only, it's the second largest because last year's was higher, it was 15%. And so deficits increase even after the pandemic goes away, from 5.7% of GDP in 2031 to 13.3% in 2051. So we have a 50-year average of our deficits at 3.3%. And even I think that's high. I don't think you should spend more than you take in or more than the growth of the economy. And so personally, I'd like to see no deficit. I'd like to see I take in taxes, I spend. If I take in less because the economy's not doing so well, I spend less. I control myself. We have a big windfall. By the way, we drill some more oil. We make some more money. All right, now you can spend some more. Do some more programs, right? Invest in the future. Build a road. Build a highway. Build a bridge. Build an airport. Build some schools, right? Federal schools. Build a new university. Illinois could use a new university. But until you do that, until you actually bring in more money, you got to spend less. And so I know we've spent a lot of money. So stop, okay? Stop spending so much. You can't have a 15% deficit last year and a 10% deficit this year and a 6% average deficit for the next 10 years. I think that's okay. So how do you pay for this? Well, the good news is the government has the printing press. And so this $20 bill, right? These don't cost $20 to make. What do they cost? Like a penny. So I make $19.99 every time I print one. The government can pay the bills this way. It's fine. What happens, that's called inflation. Inflation means that the money's worth less because we make more of it. Okay? So I got all these 20s. We're going on vacation. I want to make sure I got some money to buy ice cream and go on rides and stuff, whatever. But that's one way. We could print our way to greatness. Okay? But that means the money's worth less. Just remember that. And that means when you go to buy gasoline for your car, money's worth less. The oil, the gold, the Bitcoin, everything goes up in price. Okay? Inflation. Inflation goes up when the money's worth less. So that's not good. The other thing we could do is we could sell bonds. I wish I had a bond. I was going to show you a bond, a U.S. savings bond, right? But what happens then is that the savings bond is worth less. The Treasury bond is worth less. So it's worth less, the yield goes up. So imagine if I could sell a bond to the U.S. people for 100 cents on the dollar. I'm feeling pretty good, right? I borrow $100. You're going to pay me $100. That's great. It's a fair exchange. Maybe you'll even pay me $101 for my 100. I think that's even better, right? Saving money as a government. But what happens over time is maybe you'll only pay 95. So now it costs me a little more. So I sold the bond for 100. Maybe somebody bought it. Maybe a year later it's worth 90. They lost money. Now next time they go to buy the bond, they're going to want to pay 90. And so now it costs me an extra $10 to borrow the 100. It's rough. And that's the equivalent in higher interest rates. And so the interest rates are really a determinant of there's a lot of supply coming out. 1.9 billion. I got my stimulus check, I think. It's in my bank account. Who paid for that? A bond. They sold $1,400 worth of bonds to pay me my check at interest. And so that's why. That's what's going on with all this. And so it's not just a one and done. This is going to be a story that's going to be told for the next 6 months to a year. Now I want to tie it back. By the way, I did go to University of Chicago and I studied economics, and I did go for a finance MBA to Northwestern, and I did go partway through a PhD in management sciences, which had economics and statistics and things like that. So I do know what I'm talking about here. The Consumer Price Index, okay? So there's a CPI, Consumer Price Index. That is a measure of the average change over time in prices paid by urban consumers, because it's easier to capture that. I mean, rural might be different, right? But urban customers for a market basket of consumer goods and services. Now, the basket maybe doesn't change as often as it should. Maybe they're not measuring it in the right places, but they're doing this all the time. It's a pretty good indicator. So what I'm going to say is the absolute number may not be right, but it's up or down, right? So you trust the trend. So it rose 0.4% in February. So what that means is that's a 5% annual rate. 0.4 times 12, 4.8, rounded up. 5% inflation. It's really high. The whole thing rose only 1.7% over the past 12 months without any kind of seasonal adjustment. So it's at 2%. The government wants it at 2%. The Federal Reserve Bank said it's got an average 2%. Right? That's healthy. Right? For me, healthy is zero inflation. My $20 bill should be worth $20 this year and next year. Don't take 2% of it away by printing more. Let me have my $20. I got it in the wallet already. Leave it in there, right? And so what you see, though, is food. Food's up 3.6%. This is the 12-month. Energy is up 2.4%. And by the way, there's something we can do about that. I really get worried when I see the price of energy go up, because I hear people talk about global warming and about green economy and the new Green Deal, and we're going to make oil bad. Well, oil's not bad. Oil and gas are not bad. Okay? Pipelines are not bad. Nuclear's not bad. Solar's not bad. Wind farms are not bad. Coal's not bad. You know what's bad? Being cold in the winter. Freezing to death. That's bad. Or your car runs out of gas because we don't have any, and you got to wait in long lines. That's bad. Or my factories have to shut down because I don't have enough gas, enough electricity to keep them running. That's bad. So I need energy security is what I need. I need enough energy of different kinds of sources that if it's cold in Texas, I can still heat my homes, right? So what happened is the gasoline index, I brought this up for a reason, rose 6.4% in February. Now, my wife and I were driving, and she's like, Jeff, $3 a gallon, what happened? It was $2 a gallon just not that long ago. Now it's $3. Well, it got cold in Texas. I tried to explain it to her. She's like, well, no, I don't get it. We're shutting down pipelines. I mean, we should be helping our Canadian brothers and sisters. They're our allies. Do you know the Canadians the number of oil wells that they're drilling has gone way down since the Keystone Pipeline got canceled. Because if they're drilling for oil and they can't ship it anywhere, then what are they going to do with it? They can't pour it back in the ground. So Canada, which was ramping up, is a major energy producer, working with the United States, working with Mexico for energy security for NAFTA. Now all of a sudden Canada is shutting it down. This is awful news, okay? And then when the gasoline prices go up, and then when oil starts to be out of control, what are we going to do about it? We're going to feel good that there's no oil to burn. There's no gas. So you know what? Don't drive your car. You're going to help global warming. I don't think so. You don't drive your car, you don't go to work. Or you pay $4 a gallon, $5 a gallon. That's not the answer. Please, let's do something right here. But the fact that gasoline's going up, the fact that oil had shot up to $66 a barrel front month, there's something going on, right? And so what I would say is the canary in the coal mine, the early warning is NASDAQ. It's some of these high flyers, right? Because they're worth like $1 trillion, right? So it's easy to spook. You have to really believe that Tesla is going to be worth, I don't even know what Tesla's selling for now, right? Or Google, right? These are companies that are very highly priced. And so when you say, oh, I'm going to change things around, you really put it at risk. And then you see energy is through the floor. You would think with gasoline so expensive and oil so high that these would be in great shape, but they're not. They're actually really hurting. And so we're damaging our industry, energy industry. Please fix it. So this is where I think things are happening. This is what I think is going on. And so if I just point out a few things. So the S&P 500 looks like I've only got a couple days here. So let's pull it back to this is actually the S&P 500, the NASDAQ Composite, and the Russell 2000. And I like to show all three of them together because they're all U.S. stocks. They're all listed in the exchanges. And but they're different, and they act differently. And I love it now because we run our model, and we pick different indices. So you start to see they don't always move in the same direction, which is great. And so let's take a little look-see. So blue is S&P, green is NASDAQ, purple is the small stocks, the Russells, and Russell 2000. So when we look at the beginning of the week, the NASDAQ dropped right away, down 2%. NASDAQ recovered, up 1%. Down 1%, up 1%, down 2.5%, 3%. Looks like it's going to finish the week down 1%, 1.5%. That up and down, that volatility is not that healthy. It's actually really not that healthy. People get nervous. They lose money. They all came back together, though, on the 16th in the morning. And they also came back together at different points during the week. But you can see the S&P was a little more flat. NASDAQ, and then here's the Russell really moved. The Russell was down like 3.5% at one point this week. Small cap, Main Street. Main Street suffered this week in the stock market. So just a lot of volatility, a lot of movement. Just want to point that out to you. We talked about the Treasury yield curve. I think this is important. This is a very simple chart. These are yields by day, 5 days. And you can see Monday looked pretty normal. Yields were dropping. Tuesday, yields were dropping. 1.59. That's actually a really nice number. I love that number. It brings warmth to my heart. But Wednesday jacked up to 1.67. Thursday, 1.74. I haven't seen 1.75% interest rates in the 10-year for a while. I'm going to pull back the chart. We're going to take a quick look. And we're at 1.73. That's pretty high. Let's go back a month. We're at our high. Let's go back 6 months. We're at our high. So for 6 months, I mean, this rate was 0.7, right? It's up. Let's go for the year. It's up. 5 years. All right, over 5 years, not so bad. So interest rates were higher before the pandemic. Actually, in 2018, they were at 3%, and it was fine. The market was doing great. Everyone was up. But that's because there was a sense that there was economic prosperity. There were tax cuts. People were investing for the future, right? And so interest rates going up on 10-year money makes all the sense in the world. You know, when our previous president took office, the rates were down 1.45. We were in a life support situation there, right? But you start cutting taxes, you start feeling good, you pop those rates up, right? So I think what's happening now is people are starting to feel good. We're just gonna have to see what happens. And so that's on the rates. Show you a little bit about oil. We talked about it, how oil dropped through the floor. I found a really nice chart that talks about all the different things that we might follow for the week on one chart. So let's see if I can zoom on in, right? Let's take a look at what's up. So what's up for the week? Palladium, 11%. That's not a big thing for me. The VIX is up. That's the fear index. Corn, hogs, lumber, soybean. So food stocks are up. Silver, gold, those are up. The DAX was up. Okay, rough rice is up. So basically, inflation is up. Food is up. It's going to be more expensive when we go to the grocery store. I'm sorry. I know most of you like to eat, so it's going to cost a little more. Let's talk about what's not going to cost more. The U.S. dollar actually did well. The U.S. dollar went up a little. So the good news is, if you go travel to Europe for a little vacation, it's going to be a little cheaper. The problem is that when we sell things to Europe, or we sell things to Asia, they're a little more expensive. So it hurts our exports, helps our imports. We import more, we have fewer jobs, maybe. We make fewer things. Now we go the other way. And we take a look. So, gasoline, down 10%. Heating oil, down 7%. Canola oil's down. The crude oil, Brent crude, is down, right? So basically, oil is down 6 to 9.5%. There's a saying that I like for the markets, right? The markets climb a steep set of stairs. When they go up, they take the elevator when they go down. So you think about oil, how hard it is to get the price of oil up $6 a barrel. Oh, down a little bit. But when they go down really fast. Take the elevator, right? Cocoa, coffee, cotton, soybean oil. The Russell's down 2.5 points, 2.5%. Natural gas is down. The funny part is natural gas is so low anyway. It's such a cheap, clean source of energy. You know, sugar's down for all those with a sweet tooth. And then you see a lot of stuff right there in the middle, less than a 1% change. And so I think the net of it is food's more expensive, oil's less expensive, and now petroleum products have dropped through the floor. And again, I think that's because of our president calling the Russian people and the Russian president a killer. So those are dangerous words. So now I'm going to switch over. I'm going to talk about my one stock that I hold. And so in all the stocks, so everything in my asset portfolio is passive. Indexes, hedge funds, but I don't have any say over the management of that money. Except for one stock. I own one stock. Summit Midstream Partners. And so anytime I tweet about it, I'm long. I'm sorry. I'm long and I'm strong on this one. And haven't sold a share. So we take a look, and there's a story that I want to tell. So if you look at the stock, it kind of peaked out right there at $29. I wish I could draw a line. Right there, $29. And it basically states, so what happened was last Friday I posted a tweet. Somebody posted 32,000 shares. 32,006 shares at $29. And nobody ever does this. The stock only trades like 50, 60,000 shares a day. And for someone to post, boom, I got to dump 32,000 shares at $29, they sent a message to the market. So what happened is the market bounced up against 29 over and over and over. It's like a horizontal line that you could draw right at 29. Until today. And today, the market got tired. And the market has decided not to press up against the $29 line, but instead it's moving into, looks like a little bit of a triangle at around 26.80. And so we don't know whether the triangle is going to keep going down or it's going to go up. We really don't know. But here's what we do know. We know that there's 6.1 million shares of the stock. There's another 667,000 shares. I just read a prospectus. The people that own those shares, which was the previous general partner, they're going to be doing a secondary offering. They're going to be selling those shares. So, all right, I get 10% more shares I'm going to have to handle. That's fine, right? If I've got 100 shares, now there's another, they're worth 90 shares. It's like inflation, right, where the money went down. So I diluted. That's fine. I noticed something else, right? They're trading, and I think this is a great idea, but it really hurts the common unit holder. So they're going to issue a maximum of 2.16 million, which is roughly a third. It's actually more than a third. Maybe it's 35% more dilution. Those stocks are coming out to turn in about $91.2 million worth of debt. Preferreds with accumulated distributions that have been held. Now, truthfully, I love that they're paying off the debt. In fact, earlier this month during the earnings call, they said they've, in addition, as of February, had already paid $40 million of their revolver. So you got $40 million, you got another $91.2 million. Maybe, because I've noticed there are people buying bonds, maybe they've been buying up some bonds at a discount in the market. So let's round it up. Let's say that they've did another $10 million in the bond market. So I got 40 plus 10 is 50, another 91. It's $141.2 million of indebtedness. It's about 10%. It's a little less than 10% of the market value of their debt. That's awesome. They're getting rid of that, right? It just means that they're going to be safe. They're sound, fiscally responsible. They're going to have less leverage. It's going to save them money with every month when they pay those interest payments. But for me, it means I got to worry that there's 2.16 million shares and another 666,667 shares hitting that market soon. I don't know when. I know the 2.16 million maximum is going to be April 3rd when they get accepted. So what I could be seeing here is an arbitrage between the preferreds, 27 shares for one preferred, to this. So when the offer was made, the preferreds were trading at $600. And the stock had just gone through the roof, right? So hey, this is a great time. So let's take a look. I got $600 and I divide it by $27. And I'm at $22.22 a share. So at $60, $22.22 a share, I'm feeling pretty good. You know, the stock, where's it at now? 26.71. So there's two ways to look at it. I could drive the price of the stock down to $22 a share, and my preferred bondholder is still doing pretty well, right? Or I go the other way, right? I take $26 a share, 26.71. I multiply it by 27 shares, and the preferred can trade as high as $721. So I got a bit of an arbitrage here because the preferred isn't trading at $721. It's trading at maybe $60, $65, or $650. So we're basically gonna drive the stock price down a little bit in a short term, I think, until that that supply hits the market. And I'd read on a Yahoo Finance chat board that it's possible that those preferred holders are going to sell short, like at the $29, because they know they're going to turn in the stock. You're going to turn in the preferreds. They're going to get the common, and then you're going to pay back the shorts. So, and if who cares what the common trades at on April 3rd, right? Because I locked in my 29. I feel great. Just to be honest, $29 times 27 shares. God, I should have bought it. $783. Can that be right? $29 a share times 27 shares is $783. They announced it. It was at 450, and then the minute they announced it, it hit 600. If you would have had preferred and you would have bought it at 450, and now you're selling it at 783, yeah, these guys are paying back their debt holders beautifully. They're really giving them a nice deal, and so I don't mind. I think it's great, right? Let's be patient. Debt comes first, but that's what's hurting the stock price. And so we're still long, we're still strong. We still love what they're doing, and so that's what's going on there. Now I'm going to talk a little bit about the firm. A couple things to share. First off, we are closed for spring break. So after this call, and I got one more paid client run I got to do tonight, tomorrow morning we're getting in a car and we're going away. We're going to the mountains, no computers. I'll have my phone, but I probably won't even be on it too much. And the guys are going to take time off. And so if you buy an analysis, please let us know the date that you'd like us to run it. We're going to be running back on Sunday the 28th. And that's where we are. So the second thing is, I want to talk about long and short again, because I'm seeing some nice things, right? And by the way, some people, they don't complain, but they're like, "Oh, Jeff, you're selling, you're marketing, you're a research guy. You shouldn't be selling anything, right?" No, I am. I'm selling. Excuse me. I'll explain why, right? If you're not a customer and you don't run the model, you don't talk to me about what we're doing. You talk in generalities. My mom today said, "I heard IBM's got something in cloud and quantum, Jeff. You ought to look into it." That's helpful. Hi, Mom. I love you, by the way. But what's really helpful is if somebody pays $150 and buys an efficient stock portfolio. And then depending on if I know the person, I know what they want, I can give them the stock picks, or I can give them like a 10-page report, right? Which costs me a couple hours to write, and I don't care. I really share with them the different solvers we use, the math, the physics. I get into the whole thing. Then they come back and they want to talk about it. That's where we learn. That's the value, right? They also get that pick confidentially before the market opens. They could actually put some money to work and probably make a lot of money. But that's not the point. The point is, let's have that conversation. And so it's $150. I have had some people say that maybe they couldn't afford to pay, and I'm willing to work a deal. So if it's an issue where you can't afford the $150, you call me. You got my number. 847-780-4401. I can put a coupon code out there for you. By the way, I was buying Girl Scout cookies for people, right? It's nice. You do things. I give a free t-shirt. I don't care. We'll work it out. But you get an efficient stock portfolio. Those are the best picks. Those are the best stocks. So imagine I gave you 5 stocks and they work really well together. And basically they're going to beat the market with less volatility. That's what the model is trying to do. We have another one now. That's a scary looking bear, by the way. Why would I have a bear on my website? Because we also pick the worst stocks now. I love that, by the way. What a cool thing. This was a paid client, right? Somebody said to do this. We'll pick the dogs. Who wants the worst stocks? Well, it's easy. If you think the market's going down, you want some exposure to the downside, you want dogs. So you short the dogs, or you buy puts on the dogs. You go long the all-stars, and you buy calls on the all-stars. You could even run a 50-50 exposure. That way, if the market, you don't care which way the market goes, because you're going up and you're going down, right? You have both. So we'll pick the worst ones. We did fix our dividend bias, which is great. Heard from the client that it's better now than it was before. And but this is the big thing, right? So we now can pick great stocks, great stock portfolios, and we can pick the dogs. And we're working still on refining our dog pick to really pick dogs. Like, how can I really double down on the worst stocks, the worst ever?
It's 15 hours.
We're going to. If you want to be involved in that research, give me a call. Again, I just said the number before. And this works. So I had a call yesterday with one of our early clients. He's like, "Jeff, I made so much money on your picks. Oh my God. So much money, so much profit. It's awful. He's like, he buys companies, he gets involved in things. He's a director. The investments are kind of on the side. They just keep him busy. He loves it. He has time on his hands. Made a lot of money. And so it's nice. He wants to run some more runs, but his money's tied up because the stocks are up. He doesn't want to sell them. So we're doing good. We're doing good here. We're doing well. Now, we do have one issue. And the one issue that we have, and I'm still fighting it, right, is the market data services. And we're going to get close. We're probably going to have to go ahead, reach out to NYSE, reach out to NASDAQ, and buy their data feeds. And truthfully, it's fine if we have to do it. Prices are going to go up if we have to, because that means the minimum monthly is going to be more. I may not raise very fast, but you could be talking like 30, 40 grand a year just to buy the market data. And so what's happening is, and I've noticed this because I'm looking through the GitHubs for the APIs, and consumer market data services, they seem to be, monkeying around with them a little bit. And so just last night, so I'm trying to work around the data providers sometimes kind of messing with the data. I spent 3 days working on this, right? I've got these great tests. I'm able to pull out the stocks that they're monkeying with. It's awesome, right? We're not talking a lot of stocks either. It's just enough to ruin the analysis. I have to do it over. So last night I got it done. I ran it. I feel so good about it. I got it all clean. And then the very last stop, they took 1% of the stocks and they flipped something. And I caught it, and I'm like, oh, come on. So then I just hit run again, and it came back perfect. So I don't know why, but there's some funny business going on. And so the next step is to buy more. So we did buy a new Mac Pro. By the way, it runs faster, it runs better. It's got 64 gig of ECC RAM. Much more powerful processor than the old Mac. I had an iMac. Now I have an iMac Pro, which is pretty powerful. And we will be updating our server as well. I don't know if I'm just going to max out the memory or if I'm going to go with a brand new server. Depends. But yeah, we're going. And in terms of what the team is doing, it's, we got a lot of irons in the fire. I would say most of the commercial focus is on this model. We've got a paying customer, consistent customer, so we're running a lot of runs for them, and it's good. And personally, I'm learning a lot about the market just having my one stock pick, my one investment, because then I've got to go really deep and try to understand what's happening. I'm understanding the charts and the technical analysis. I'm understanding the fundamental analysis of the company and what they're doing. I can't wait for them to release earnings, and I can start to dig through the earnings and start to really understand what did they do differently, and what are the secondary and tertiary effects that could affect the stock price. So, all right, I want to thank you. Thank you very much. It's Friday, March 19th. This is Jeffrey Cohen, Chicago Quantum, and we talked about the market update. There was a lot to talk about. I was kind of surprised. And we talked about our business and how we're focused very much on our model and making money in the stock market, actually helping you make money in the stock market. So thank you again. We'll talk soon. Bye-bye now.